There is a number flashing across financial markets this week that almost nobody is talking about correctly. It isn't the price of gold. It isn't inflation. It isn't even the Federal Reserve's latest decision. It's something far more unsettling. For the first time in nearly a century and a half, gold has reached a level that has historically appeared only when the financial system itself was undergoing profound change. That should make every investor stop. Because when an asset that has survived kings, empires, world wars, depressions, and every modern financial crisis suddenly sends a signal this rare, history suggests it isn't predicting what happened yesterday. It's warning about what could happen next. And if you own gold, or you're responsible for protecting your family's savings, you need to understand why some of the world's biggest institutions are paying closer attention than ever before. Over the next few minutes, I'll show you the hidden message most headlines completely missed, and why this may be one of the most important financial signals of our lifetime. Most people think they know what a record in gold means. They see the headline. They glance at the price. Maybe they tell themselves, gold is expensive now. I probably missed the opportunity. Then they move on with their day. But this time is different, because what just happened isn't simply another record. It is a signal. And not the kind of signal that flashes across your television screen for a single afternoon before disappearing into tomorrow's news cycle. This is the kind of signal that appears only a handful of times in a lifetime. Ladies and gentlemen, if you own gold, or if you've ever wondered why the world's largest investors continue quietly accumulating it while everyone else debates stocks, interest rates, and artificial intelligence, I need you to stay with me for the next few minutes. Because today isn't really a story about gold. It's a story about money. More specifically, it's a story about trust. This week, gold reached a level that analysts describe as one of the strongest relative performances against the financial system in well over a century. Think about what that actually means. Governments have changed. Empires have disappeared. Entire monetary systems have been built and abandoned. The world survived 2 world wars, the Great Depression, the oil crisis, the dot-com bubble, the global financial crisis, a global pandemic, and the fastest interest rate hiking cycle in decades. Through every one of those chapters, gold remained exactly what it has always been. A piece of metal. It doesn't become smarter during recessions. It doesn't work harder during inflation. It doesn't invent new technologies. It doesn't earn profits. It simply exists. And perhaps that's exactly why the world keeps returning to it whenever confidence begins to weaken. Because gold never asks you to trust a government. It never asks you to trust a corporation. It never asks you to believe that politicians will balance budgets or that central banks will perfectly manage inflation. It simply waits. Patiently. Century after century. That patience is what makes today's signal so extraordinary. When something that changes so little suddenly changes in price so dramatically, experienced investors ask an unusual question. Not, what happened to gold? But, what happened to everything else? That is the question almost nobody on television is asking. Imagine standing in front of an old lighthouse that has guided ships safely for hundreds of years. Every day, sailors glance toward it. Most days, nothing happens. Then one evening, the light begins flashing a warning unlike anything anyone has seen before. Would you assume the lighthouse suddenly became unreliable? Or would you wonder what danger had appeared out at sea? Gold works much the same way. For thousands of years, it has acted less like an investment and more like a measuring instrument. A financial lighthouse. Most of the time, it sits quietly in the background. But occasionally, it begins flashing, not because gold itself has changed, but because the environment around it has. That is where so many investors misunderstand what they're seeing. They assume rising gold prices automatically mean people suddenly love gold. History suggests something different. Often, people aren't running toward gold. They're moving away from uncertainty, away from doubt, away from promises they no longer feel completely comfortable trusting. That distinction changes everything. Because gold is rarely the beginning of the story. It is usually the ending. The final chapter in a chain of decisions made by millions of investors trying to answer one simple question. Where can I store purchasing power if the future becomes less predictable? Now, let's be honest. The world doesn't exactly feel predictable today. Inflation may have cooled from its peak, but few families believe prices have returned to normal. Government debt continues climbing. Interest costs continue rising. Global trade is changing. Geopolitical tensions remain elevated. Artificial intelligence is transforming industries faster than economists can model. Even the people responsible for managing the world's largest economies admit that uncertainty has become unusually high. When uncertainty rises, confidence becomes valuable. And when confidence becomes scarce, history shows that investors begin searching for assets that don't rely on confidence alone. That brings us to one of the most important misunderstandings in modern finance. Most people believe the price of gold tells us something about gold. It doesn't. Think about a thermometer. When you look at a thermometer on a hot summer afternoon and see a high temperature, you don't conclude the thermometer suddenly became hotter. The thermometer is simply reporting the environment around it. Gold often behaves the same way. It reflects changes occurring within the financial system. Changes in purchasing power. Changes in confidence. Changes in monetary expectations. In other words, gold is less like the weather, and more like the instrument measuring it. That perspective helps explain why institutional investors pay attention to gold even when they don't own large amounts of it. To them, gold isn't merely another asset class. It is information, a message, a quiet signal that markets may be reassessing risks beneath the surface. Because markets rarely announce major changes all at once. They whisper first, then they speak louder. Only much later do headlines catch up. This is why some of the world's largest investment firms spend so much time studying relationships. They compare gold to government bonds, gold to real interest rates, gold to currencies, gold to central bank reserves. Because those relationships often reveal much more than a single number on a trading screen ever could. And recently, many of those relationships have begun changing together. That rarely happens without reason. Now, before anyone misunderstands what I'm saying, let me make something perfectly clear. A historic signal is not a guarantee. Gold has experienced major corrections before. It has gone through years where it disappointed investors. Anyone telling you that gold only moves in one direction isn't offering analysis. They're offering certainty where certainty simply doesn't exist. Markets don't work that way. The future doesn't work that way. And responsible investing certainly doesn't work that way. The purpose of this discussion isn't to convince you to buy anything. It is to help you understand what some of the world's most experienced investors appear to be watching beneath today's headlines. Because there is one phrase quietly spreading through institutional circles. A phrase that explains why many portfolio managers have become increasingly interested in hard assets over the past several years. It isn't a catchy television headline. It isn't political. It isn't emotional. It is surprisingly simple. And once you understand what it means, today's historic move in gold begins making much more sense. In fact, it may completely change how you think about money itself. Because in part 2, we're going to uncover the deeper force quietly reshaping financial markets, a force driven by government debt, central bank policy, inflation, and a growing concern that the value of paper currency may be changing in ways most people haven't fully recognized yet. And when you understand that bigger picture, you'll begin to see why professional investors aren't just watching the price of gold. They're listening to the message it's trying to send, the quiet shift institutions are preparing for. If part 1 was about understanding the signal, then this is about understanding what may be causing it. Because gold doesn't wake up one morning and decide to make history. Markets don't move that way. When something as ancient and as stable as gold begins behaving differently, experienced investors assume something much larger is changing beneath the surface. The question is, what? There is a phrase that has quietly become more common in conversations among economists, portfolio managers, and institutional investors over the past few years. Not because it's new, but because it's becoming increasingly relevant. That phrase is currency debasement. Now, before that sounds more complicated than it really is, let me explain it in the simplest way I can. Imagine your town has only 100 tickets to a concert. Because the tickets are limited, they become valuable. Now imagine the organizers suddenly print another 100 tickets. Nothing about the concert has changed. The stage is the same. The performers are the same. The number of seats hasn't increased. Only the number of tickets has. Each ticket still says one seat, but everyone understands that something has changed. Scarcity has been diluted. Money works in surprisingly similar ways. A currency is valuable not only because people trust it, but because they trust that its purchasing power will remain relatively stable over time. When that confidence begins to weaken, investors naturally start asking an uncomfortable question. If my money buys less 5 years from now than it does today, where should I store the value of my work? That question has echoed throughout financial history, and every generation has answered it differently. Some bought farmland, some bought real estate, some bought productive businesses, some bought commodities, and many chose gold. Not because gold creates wealth, but because it has often preserved purchasing power when confidence in paper money weakened. Now let's look at why this conversation has become so important today. Governments around the world have accumulated extraordinary levels of debt. In the United States alone, federal debt has climbed to levels that would have seemed almost unimaginable a generation ago. Every year, more borrowing requires more interest payments. And those interest payments themselves become another growing expense. Think of it like carrying a mortgage. At first, the monthly payment is manageable. But imagine continuously borrowing more while interest rates also rise. Eventually, a larger and larger portion of your income goes toward paying yesterday's obligations instead of building tomorrow's future. Governments face similar arithmetic. The numbers become increasingly difficult. Now, this does not automatically mean a crisis is coming. History teaches us that economies can adapt in remarkable ways. Innovation can increase productivity. Growth can surprise to the upside. Fiscal reforms can happen. None of these possibilities should be ignored. But institutional investors don't build portfolios around best-case scenarios alone. They prepare for uncertainty. That is why many of them have quietly increased allocations to assets they believe are less dependent on the policies of any single government. This brings us back to the Federal Reserve. Most investors think the Fed controls everything. In reality, even the Federal Reserve operates within limits. Raise interest rates too aggressively, and borrowing slows. Businesses invest less. Consumers spend less. Economic growth weakens. Lower rates too quickly, and inflation may accelerate again. Financial conditions become easier. Demand increases. Prices can begin climbing faster than policymakers would like. It's a balancing act with no perfect answer. Every decision solves one problem while creating another. That's why experienced investors spend less time asking, "What will the Fed do next month?" and more time asking, "What choices will the Fed realistically have over the next several years?" Because those are very different questions. Now consider another trend that has received surprisingly little attention outside financial circles. Central banks themselves have become significant buyers of gold. Think about that for a moment. These are the very institutions responsible for issuing currencies. They employ economists, statisticians, and some of the most experienced financial professionals in the world. And yet, year after year, many have continued increasing their gold reserves. Why? Not because gold earns interest. It doesn't. Not because it pays dividends. It doesn't. And certainly not because central bankers suddenly became gold enthusiasts. They buy it for a much simpler reason. Diversification. Insurance. Resilience. Gold is one of the few internationally recognized reserve assets that carries no promise from another government. It doesn't depend on corporate earnings. It doesn't require a country's ability to repay debt. It simply exists. That characteristic becomes more valuable when uncertainty rises. Now combine that with another important development. Around the world, many countries have begun reconsidering how much of their reserves they want concentrated in a single currency. Again, this doesn't mean the dollar is disappearing. Far from it. The US dollar remains the world's dominant reserve currency for good reason. Its financial markets remain the deepest and most liquid on Earth. But diversification doesn't require replacement. It only requires reducing concentration. Professional investors understand this instinctively. If you own a portfolio, you probably don't want every dollar invested in one company. The same logic often applies to sovereign reserves. Many nations are simply choosing to spread risk across multiple assets. Gold has become one of those assets. Now let's connect all these pieces together. Government debt continues rising. Interest costs continue increasing. Central banks continue buying gold. Investors continue debating inflation. The Federal Reserve continues balancing difficult trade-offs. Individually, none of these developments guarantees anything. Collectively, they paint a picture of a world becoming more uncertain rather than less. And uncertainty has always changed investor behavior. Not overnight. Slowly. Almost invisibly. Until one day everyone notices at once. History shows this pattern repeatedly. The biggest financial shifts rarely begin with panic. They begin quietly. One institution adjusts its portfolio, then another. Central banks slowly increase reserves. Large asset managers rebalance allocations. Pension funds make incremental changes. Each decision appears small, but together, they gradually reshape global capital flows. By the time ordinary investors notice, much of the repositioning has already taken place. That may be the most important lesson of all. Professional investors don't wait until uncertainty disappears. They prepare while uncertainty still feels uncomfortable, because waiting for perfect clarity often means paying a much higher price later. Now, does that mean gold must continue rising? Absolutely not. Markets never move in straight lines. Gold has experienced painful corrections throughout history. It can remain stagnant for years. It can disappoint investors who expect quick gains. Anyone claiming otherwise isn't respecting history. But the deeper message isn't about predicting next month's price. It's about recognizing that the world's largest pools of capital appear to be preparing for an economic environment that may look very different from the one many investors became accustomed to over the past 2 decades. And that brings us to perhaps the most important question of all. If history has seen periods like this before, what happened next? Because there is one decade that professional investors return to again and again whenever conversations about inflation, debt, monetary policy, and gold begin accelerating. The decade wasn't defined by technology, or artificial intelligence, or cryptocurrencies. It was defined by something much more powerful, a complete transformation in how people thought about money itself. History doesn't repeat, but it often rhymes. Every generation believes its challenges are unique, and in many ways, they are. The technology changes. The headlines change. The politicians change. The financial products become more sophisticated. But human behavior? That changes very little. Fear still spreads faster than patience. Optimism still peaks near market tops. Panic still arrives near market bottoms. And perhaps the greatest mistake investors continue making is confusing price with value. That distinction may be the single most important lesson gold has to teach. Because throughout history, gold has gone through long periods when it looked completely unnecessary, right before the world suddenly remembered why it had trusted it for thousands of years. The best example is the 1970s. Now, I want to be careful here. I'm not suggesting history is about to repeat itself exactly. It never does. The economy is different. The financial system is different. The Federal Reserve operates under a completely different framework. Technology has transformed global markets in ways nobody could have imagined 50 years ago. But history has a habit of rhyming. And that is why investors continue studying it. During the early 1970s, confidence in paper money began to weaken. Inflation, which many believed would remain temporary, proved far more persistent than expected. Prices climbed steadily. Families discovered that every trip to the grocery store seemed more expensive than the last. Savings accounts that once felt secure quietly lost purchasing power. The numbers inside bank accounts remained the same. What those numbers could actually buy became smaller every year. And while millions of people focused on the balance printed on their monthly statements, something else was happening beneath the surface. Gold was sending a message, not because gold had suddenly become magical, but because the purchasing power of paper money was changing. Many ignored that signal. Others dismissed it as speculation. Only later did they realize they had been watching the price while missing the message. That lesson remains remarkably relevant today. Not because today's economy is identical, but because today's question sounds surprisingly familiar. How long can governments continue carrying enormous debt? Will inflation eventually settle near central bank targets? Can economic growth outpace rising borrowing costs? Will investors continue trusting government debt as confidently as they have for decades? Nobody knows those answers with certainty. And anyone who claims they do is selling confidence, not knowledge. What we can do is think through the possibilities. Let's consider 3 realistic scenarios. The first is the optimistic scenario. Inflation continues cooling. Productivity improves through technological innovation. Artificial intelligence increases efficiency across industries. Economic growth remains healthy enough to support government finances. Interest rates gradually normalize without triggering a severe recession. If that happens, gold could experience periods of disappointment. It has before. History shows that when confidence in financial systems strengthens, demand for defensive assets often softens. That outcome is entirely possible. The second scenario is more balanced. Inflation moderates but refuses to disappear completely. Government debt remains historically high. Central banks continue walking a difficult line between supporting growth and controlling prices. Markets experience repeated cycles of optimism followed by renewed uncertainty. Gold, in that environment, may remain volatile. Some years strong, some years frustrating. Not a straight line upward, but a long-term reflection of an economy adjusting to a new reality. Then there is the third scenario. The one institutions quietly prepare for even if they hope it never arrives. Debt continues expanding faster than economic growth. Inflation proves more persistent than expected. Governments increasingly rely on monetary policies that gradually reduce the real burden of debt. Confidence in purchasing power weakens. Hard assets become increasingly attractive as investors seek stability outside traditional financial promises. Notice something important. None of these scenarios is impossible. None is guaranteed. Professional investing isn't about predicting exactly which future arrives. It's about recognizing that multiple futures are possible and preparing accordingly. That is precisely what institutional investors do differently from emotional investors. Which brings me to something I have observed again and again through decades of market history. Markets rarely punish ignorance as severely as they punish emotion. Fear convinces people to sell quality assets after they've already fallen. Greed convinces people to buy excitement after prices have already soared. Patience, by contrast, rarely feels exciting. It often feels lonely. Imagine planting an oak tree. For years, almost nothing appears to happen. The tree grows slowly. Neighbors wonder why you bothered. Some laugh. Others lose interest. Then one day, decades later, that oak becomes the strongest tree in the neighborhood. Investing often feels similar. The greatest rewards rarely belong to those chasing yesterday's headlines. They belong to those who understood what they owned before everyone else recognized its value. Again, this is not a prediction about gold. It is a lesson about behavior. Now, if you're wondering what experienced investors will be watching over the coming months, there are 4 indicators worth paying attention to. First, watch real interest rates, not just headline interest rates. Gold often responds more to inflation-adjusted yields than nominal rates alone. Second, watch central bank purchases. If official institutions continue adding gold to their reserves, it suggests confidence in diversification remains strong. Third, watch inflation expectations, not just inflation reports. Markets move based on what investors expect tomorrow, not simply what happened yesterday. And fourth, perhaps most importantly, watch the Treasury market. Because government bond yields influence everything from mortgage rates to corporate borrowing costs. When the Treasury market moves, the ripple spreads through the entire financial system. Gold doesn't exist in isolation. It responds to the broader environment. That is why serious investors study the system rather than chasing headlines. So let me leave you with one final thought. This video was never about convincing you that gold is destined to rise. It was about helping you understand why an asset that has existed for thousands of years still commands the attention of the world's most sophisticated investors. Gold does not predict the future, but it has an extraordinary history of reflecting changes in confidence long before they become obvious to everyone else. That alone makes it worth paying attention to. Because whether you're optimistic about the economy or deeply concerned, one principle remains timeless. The strongest financial decisions are rarely made during moments of panic. They are made during moments of understanding. And understanding begins by asking better questions. Not, how high can gold go? But, what is gold trying to tell us about the world around it? That is the question institutional investors continue asking. Perhaps it's the question all of us should ask. If today's discussion gave you a different way to think about money, inflation, and the signals hidden beneath the headlines, I'd genuinely like to hear your perspective. Do you believe gold's historic rise reflects temporary market emotion? Or do you think it's warning us about something much deeper? Share your thoughts in the comments below. I read them carefully because thoughtful conversations often reveal insights that headlines never do. And if you enjoy calm, evidence-based discussions about gold, silver, macroeconomics, Federal Reserve policy, and the forces quietly shaping the global financial system, consider subscribing. The headlines will continue changing every day. Prices will continue moving every hour. But the deeper story, the one unfolding beneath the noise, is often the story that matters most. And until our next briefing, remember this. The market's loudest movements usually capture attention, but its quietest signals often create the greatest opportunities for those patient enough to understand them.